Let's talk about the Federal Reserve, because right now, they are absolutely trapped. If they cut rates, they risk fueling massive inflation. But if they hike them, they could break the entire banking system. So in this explainer, we're going to break down a very specific strategy. It's called the barbell, and it's designed to actually profit from this indecision and the crazy yield curve volatility it's creating.
I mean, this quote just nails it, doesn't it? It perfectly captures the high-stakes, tightrope walk that central bankers are on right now. They are stuck between a rock and a hard place. And that kind of environment, that kind of uncertainty, it creates huge volatility, which, means a ton of risk. But as we're about to see, it also creates some pretty significant opportunity.
Okay, so let's dig into this a little deeper. Why exactly is the Fed so cornered? Well, it all boils down to one word, and it's a word that strikes fear into the heart of pretty much any economist. Stagflation. And listen, this isn't just some abstract, dusty term from a textbook. This was a painful reality that the US lived through back in the 1970s. Just try to imagine it. The economy's grinding to a halt. People are losing their jobs, but at the same time, the price of everything you buy, gas, groceries, you name it, just keeps going up and up. It is the absolute worst of both worlds and a total nightmare for policymakers to try and fight.
And this right here, this is the Fed's lose-lose scenario. Their standard playbook is basically useless. If they hike interest rates to try and fight inflation, they risk completely crushing an economy that's already on shaky ground. But if they cut rates to try and stimulate some growth, they risk pouring gasoline on the fire and kicking off a crazy inflationary spiral. There are just no good options left on the table.
So that's the big picture problem. But this isn't just a headache for economists in DC. If you hold pretty common investments, your portfolio is sitting right in the crossfire of this whole mess. And we're not just talking about today, but also about the potential stagflationary threats that a lot of people see coming down the pike for 2026.
So many of us, looking for a bit of safety, own these big, popular bond funds. You know the ones, like AGG or BND. They're sold as the stable, conservative anchor for your portfolio. But here's the thing. Right now, they are carrying a massive and often totally overlooked risk.
And this number is the key to understanding that risk. 6.5 years. Now, this isn't how long you have to hold the bonds. No, it's something way more important for your money right now. It represents the approximate duration of the bonds inside a fund like AGG.
So this idea is called duration, and it's really just a fancy way of measuring interest rate risk. Think of it like this. For every 1% that interest rates go up, the price of a bond fund with a 6.5-year duration is going to drop by about, you guessed it, 6.5%. So the longer the duration, the more sensitive your investment is, and the more its price will fall when rates rise. And this brings us to what I like to call the bond seesaw. It's a fundamental rule of investing. When new interest rates out in the market go up, the value of older bonds that pay a lower rate has to go down. It's just simple math. Now, a fund with a long duration, like 6.5 years, is like sitting on the very far end of that seesaw. Even a tiny little nudge in interest rates can send its price plunging. And that is the hidden danger in those supposedly safe bond funds. Okay, so we've laid out the problem, and we've talked about the risk sitting in a lot of portfolios. So what in the world is the solution? How do you navigate this kind of environment? Well, this brings us to a really fascinating strategy known as the anti-fragile barbell. The barbell strategy was made famous by the author and risk expert Nassim Taleb, and the core idea is actually pretty simple. You build a portfolio of extremes. You put the huge majority of your money, we're talking 80 to 90%, into something hyper-conservative and safe. Then, you take that small remaining slice and put it into something hyper-aggressive or speculative. And here's the key. You completely avoid that mushy middle, which is exactly where those risky, long-duration bond funds we just talked about live. Now, to really understand why the barbell is so powerful right now, you have to get this concept: anti-fragile. It's a step beyond just being tough or resilient. Think about it. Something that's resilient can take a hit and bounce back, right? But something that is anti-fragile actually benefits from getting hit. It gets stronger when it's exposed to volatility, to randomness, to uncertainty. And that's the goal here, to structure your portfolio so it doesn't just survive the Fed's chaos, it actually thrives on it. So the barbell has two really simple sides. First, you've got the safety net. This is the heavy end of the bar, your hyper-conservative core. Its only job is to preserve your capital. And then second, you have the protector. This is the light end of the bar, a much smaller position that is specifically designed to pay off big time if chaos hits the fan. Okay, so this all sounds great in theory, but how do we actually build this thing? Well, for each side of our barbell, we're going to use very specific types of U.S. government debt. Treasury bills, or T-bills, and Treasury inflation-protected securities, better known as TIPS.
On the safety side, we have T-bills. These things are ultra-short-term government debt, maturing in a year or even less. They basically act like cash, but the cool part is they actually pay you a yield. This gives you incredible stability, and maybe more importantly, liquidity. Then, on the protector side, we have long-term TIPS. These are Treasury inflation-protected securities. Their whole reason for existing is that their principal value actually increases with inflation, which makes them a direct hedge against the exact problem the Fed can't seem to solve.
So, to put it as simply as possible, the heavy side of your barbell, those T-bills, gives you a rock-solid foundation and a pile of cash ready to go when opportunities pop up. The light side of your barbell, the TIPS, acts as your insurance policy. It's a bet where the downside is small, but the upside is huge if the Fed loses control and we get that nasty inflation we talked about earlier. So we've built the barbell. Now for the fun part. How does it actually win? How does this structure profit from the very same volatility that could absolutely crush a traditional portfolio?
And this is maybe the most important takeaway. This whole strategy is about preparation, not prediction. You're not trying to guess what the Fed's going to do next. By just avoiding that dangerous middle ground, the long-duration bonds, you've already dodged the main source of pain. Your downside is extremely limited because most of your money is in ultra-safe T-bills. But your upside is massive because that small slice in long-term TIPS can have an explosive payoff if an inflation shock rocks the system. You've got limited risk and huge potential reward.
At the end of the day, this is how you stop playing the guessing game. You can stop stressing about the next Fed meeting or the latest inflation report. The barbell is structurally set up to be okay no matter what happens, and to benefit in a huge way if volatility spikes. You are literally positioned to profit from the Fed's impossible situation.
So as we wrap this up, I'm going to leave you with a question to really think about. Take a hard look at your own investments. In this world of economic uncertainty, with central banks totally cornered and the old rules breaking down, is your portfolio designed to be fragile, to break when the unexpected happens? Or is it designed to be anti-fragile, to actually get stronger from the chaos?